And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. I'm Mike Harrison, and yes, we are always working on your financial freedom. It's my privilege to be joining you today. Last week, I did a show on 6 rules that will pretty much guarantee your personal wealth will grow to such a degree that in a short amount of time, comparatively, your net worth will be such that you will be considered in the top 5% of wealth, net wealth individuals in the United States, the top 5%. And these steps are not what you think they are. They're very simple. I think they are. But the sad, unfortunate truth is that many people out there, for whatever reason, personal reasons or maybe behavioral reasons or just maybe they just don't want to, they won't follow the rules. But how awesome is it that you can just apply these 6 rules to your everyday life, and there's nothing that will stop you from being in the top 5% of net worth in the United States. Pretty amazing. And the net worth is not as great as you may be thinking out there if you missed that show. I'll tell you, the top 5% of net worth in the United States really is just a tad over $1 million. It's $1,030,000. So 6 basic rules, you follow that, you're going to find yourself a millionaire. You will accumulate it. I can pretty much guarantee that. Follow those rules. Now, you might even find yourself in the top 2% of net worth. So go from the 5% to the top 2. It remains, though, your net worth would be 2.472, right? $2,472,000 to be in the top 2%. 6 very basic rules. What are those rules, you may be asking? Well, and if you miss that show, you'll want to go pick it up, and I go into detail on each and every one of these rules. But rule 1, don't be stupid. Rule 2, you need to want it. You must want to succeed. Rule 3, be responsible. Take ownership. Rule 4, learn and practice financial competence. Rule 5, buy cash flowing assets, create passive income. That's where we come in at Lifestyles Unlimited. That's what we can teach you. We're an educational and mentoring group. We have members in all 50 states. We've been around for over 30 years. Rule 6 is repeat, reinvest, create the legacy. Now, of those 6 rules, I have a couple notes. Step 1, rule 1, don't be stupid. That's the hardest one there is, right? Even occasionally, I think we all find ourselves dipping our toe in that category. I can tell you I do. There's a couple things that I do every now and then, and I go, man, that was stupid. Why'd I do that? Like skiing at 70 miles an hour. That was, I broke rule 1, and I got hurt earlier this year. Step 4 is where many successful people will stop, right? That learn and practice financial competence. My parents, for instance, right? They just, step 4, that's it, we're done. And that's where you'll find a lot of savers. That's where you'll find a lot of frugality, but it's just good people living great. They're doing well. They're not pushing any boundaries, right? They're just step by step, go to work every day, save money, make smart decisions, that sort of thing. Step 5 by far is the most powerful. That's where you begin to double, triple, quintuple your net worth. That's where compounded passive income comes in. That's where you're making money off of money that you made. That should probably be a pop song. Somebody could do that out there, maybe a rap song. Making money off of money that you made, right? That's putting your money to work. It's earning money, it's doubling, it's tripling, and then that money is still earning, and then it just goes and goes and goes. I call that the cash flow snowball. Now, the most important of those rules by far is Rule 6. That's the repeat, reinvest, create the legacy. That's where you pass it forward, right? You don't want to do all this for it to die when you die. Okay, this is the time when you can give. This is when you can share. You can give your time, give your knowledge, give your money, share your time, share your knowledge, share your money. So step 6 by far is the most important. And I share those again just because I got a ton of email on those. And if you'd like to email me, my email address is askmike@luinc.com, askmike@luinc.com. Now, 2 weeks ago, I relayed to you that we're in a moment of time where an economic tidal wave is beginning to crash. That lag effect tidal wave is crashing economically in this country. It's just the very beginning. And I mentioned that show primarily because we want to I want to review with you the incredible real estate opportunities that are out there. And I'm going to share real examples. So you'll want to stick with me and listen to the entirety of that show. But my shows are always on Monday. If you want to catch my shows, go to lifestylesunlimited.com, click on the podcast button. If you scroll all the way to the bottom, you can type in my name, Mike Harrison, you'll pull my show. Or if you're just going through the shows, and literally there's about 15 years of shows there, mine are always on Mondays. So 9/11, 9/18, 9/25, any Monday, you'll find it. You'll find one of Dale's shows, and then you'll find my show. Now, what is the cause of that crash that we're starting to see right now? Well, the cause of that is essentially economic policy in this country for the last couple of decades, maybe several decades. And those bad policy decisions have been accelerated recently, and it's just compounding the effect, right? And what I'm seeing right now is that there's no desire by the policymakers in Washington, D.C. to change course, to make things better for the citizens. None whatsoever. It seems that every policy they're making is making life more difficult, life more expensive, more competitive. What's my proof of the crash? Well, I'll tell you. Bankruptcies, right? Bankruptcies are piling up. We're seeing a surge in the amount of bankruptcies by both individuals and businesses. Personal savings. Personal savings have been depleted. We came out of COVID. The American consumer had accumulated $2.1 trillion in personal savings. I believe that was a record amount, right? So we came out of COVID with $2.1 trillion. Everyone was staying home. No one was spending money. Our savings were ballooning. Where are we today? Well, personal savings essentially is just a tad over $100 billion. Now, those are big numbers. Let me break it down. Let's say yesterday you had $21 in your pocket. Today you have $1 in your pocket, okay? So everyday people are running out of their savings. Why are they running out of their savings? Well, they're not out there just, well, some are. Some people are crazy, man. You put $50 in their pocket and they're going to come home and it's all going to be spent within a couple of hours. But for the most part, what we're seeing is consumers are having to dip into their savings just for day-to-day expenses, okay? Now, what happens when you run out of your personal savings? Well, you turn to the credit card. What's going on with credit cards in this country? Well, credit card debt is at the highest level ever. This is not a good thing. So Americans have exhausted their personal savings. They've turned to the credit cards. They've maxed out their credit cards. The interest rates on credit cards are at the highest ever, 22% on average. It's outrageous. So what happens when you run out of your savings, you've maxed out your credit cards, what do people do for money? Well, I'll tell you what historically people have always done for money is they would turn to their biggest asset, their personal home, and they would just refinance that asset, right? They'd pull out whatever they need, 25 grand, 50 grand, 100 grand, whatever that number is, and it allows people to kind of reset, right? We're going to take this 100 grand. We weren't the smartest. We burned through our savings. We burned through our credit cards. We're going to clean up all of our debt, and we're going to start fresh. Well, you can't really do that today. You can, but who's going to go from a 3% to a 7%? Chances are folks won't be able to afford the new mortgage payment. The mortgage payment's going to be elevated, right? That 7% interest on even more money. If you're pulling out another 100 grand, a refinance really it's a fancy way to say loan, right? You're taking out a loan on the value of your house. That's your equity, or you're releasing that equity, but you're still paying it. You're having to pay that mortgage back, right? So the mortgage number is going to be greater and the interest rate's going to be greater. And so people just can't afford to do it, right? If they can't afford to pay their day-to-day expenses, how do you expect them to pay another $1,000, $1,200, $1,500, whatever that amount's going to be on a refinance? They can't do it. The money is running out. Okay, this is a normal cycle. Understand that. This is not all doom and gloom. This happens. We go through these economic cycles in this country. So then what is the last resort? What is the alternative? Well, you have to sell the house, right? If you're out of money and you can't get by, you can't pay your day-to-day expenses, then you're essentially house rich and financially poor. So you got to dump that asset. You've got to sell it. Now is not really a good time to sell compared to where we have been in the last 18 months, 2 years, 5 years. It's not really the best time if you've got to sell your property. Why? Because whoever's coming into your property is taking on that larger interest rate. They're taking on that larger property taxes are up, insurance is up, everything's more expensive. And if they're having to take on more of that, it's economics 101. You're going to have to sell that home at a discount compared to where you could have sold it a year or two ago. And so that is what is creating these opportunities that we're seeing right now, okay? Right now. We haven't seen this for 10, 12 years. Now let's go back 10, 12 years. 2011 to 2022, basically every property I purchased, both multifamily and single family, every one of those, the values increased each and every year. That's not happening right now, okay? Today's market is new to me as a real estate investor. It's new to me. You may believe I'm a seasoned investor, and I guess comparatively speaking, compared to who, right? To a degree I am, but to a lot of folks that I know, a lot of my mentors, a lot of people that I bounce questions off, a lot of folks that I network with, I'm not near as seasoned as some of these folks. A lot of these folks have been doing real estate for 20 plus years. They were buying through this cycle in 2008 and 2010. Keep in mind, I didn't buy my first rental property until 2011. Okay, I didn't even find Lifestyles Unlimited till 2013. I've never gone through a market like we're going through right now, a declining market. So I'm new to this as well. I'm navigating it with a different outlook. There are a different set of rules essentially that we can follow, that we can pay attention to. Not necessarily rules, let's just say best practices. Now, what I'm not saying, I'm not as a rule of thumb saying that single family real estate values are declining. Those values are holding. What I am saying is there's motivated sellers out there that are being forced to sell their property, and they're being forced to sell their property at a discount compared to what the value is, at a discount compared to what they could have sold it for a year ago, 2 years ago, 5 years ago, okay? Now, multifamily values. Let's talk about that for just a second, because we do have single family and multifamily investors. Multifamily values are declining. Well, Mike, why are those declining and single family properties aren't declining? Because multifamily, they're a business, okay? And their values are calculated based on cap rates and based on net operating income. It's a completely different equation. The cap rates are expanding. They're going up, and it's causing the value of multifamily properties to come down. It's still some great opportunities out there, right? So we're seeing great opportunities in both single family and multifamily. Motivated seller opportunities. I'm telling you, if you have the slightest idea to begin investing in rental property, now is the time. We'll be right back after a short break.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
What does Del Walmsley, CEO and founder of Lifestyles Unlimited, think you need to succeed in this market?
It's time to buy, and so you better get prepared, you better get educated, you better get your money right. You need to get involved because you're going to need the financing. You're going to need the vendors that we have available to us. You're just going to need the interaction with people. You need to immerse yourself into real estate.
Start your real estate immersion with a free workshop live online at lifestylesunlimitedworkshop.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the show. I'm Mike Harrison. We're discussing this lag effect tidal wave, this economic tidal wave crash that we're beginning to go through in this country. I cited several reasons for that in the previous segment, but the bottom line is this lag effect tidal wave is creating opportunities where motivated sellers are having to sell. Okay, they're having to sell. There are some people out there that want to sell no matter what. They're just like, time for me to move. I'm going to go. I realize I have to discount the property compared to what I could have sold it for. But essentially, we'll put that in the category of motivated seller. Now, at the same time, we have fewer buyers. Okay, fewer buyers for several reasons. Things are just expensive economically. Our everyday cost of living has gone up exponentially. Just everything from groceries to energy to fuel to just day-to-day expenses are way up. Insurance is up. Taxes are up. People are hunkering down, right? They're not, and they're also not giving up their beautiful, low, fixed 3% interest rate on their property to go dive into a 7. So you've got fewer buyers and this compounding effect, okay? So these sellers are having to accept less. Let me give you an example. We have a service here at Lifestyles Unlimited for our upper level members, challenge or preferred members, okay? You can join at the basic level. I did, and you can still be very successful buying real estate, all right? That's where I started. You can move up at a later time if you choose to. There's a lot of opportunities and perks to being a challenge member, and one of those is that we do what's called an email blast, all right? So our folks, our realtors, we have our own realty teams that are in several different states across the country. They'll scour and find properties for our members to purchase. Now, these properties typically are not on the MLS. So if you're getting on Realtor.com and looking yourself, I doubt you're going to see this. So these are wholesalers. We've got just network with hundreds, if not thousands, of wholesalers all across the country. They send them to us because they know we're buyers, right? If you're a wholesaler and you know that a Lifestyles Unlimited member is going to buy, we're motivated buyers, okay? We're ready to go. So we have these opportunities. We'll do our analysis. If it fits the Lifestyles Unlimited model, we'll blast that out, right, to our members. You can say, hey, I'd like to be on the Kentucky, I'd like to buy real estate in Kentucky, single family, please put me on the Kentucky Blast or the Georgia Blast or the Tennessee or the Texas, what have you. You can be on all those. But here's one, okay? This one went out, again, just last week. Is this house for sale? No. I don't know for a fact that a member bought it. I would be shocked if it didn't sell. So the after repair price opinion is $240,000. Okay, so once this house is fixed up, everything's done right. That's part of the Lifestyles Unlimited model. It's a different show for a different day. After we fix everything, this property will be worth $240,000. The seller is asking $129,900. Let's just call that $130 for math, okay? Now, we have in here what's called suggested price. Our suggested price after our analysis is $110, $20,000 less. Now, what hits me with that is in 2021, the suggested price was often more than the asking price, right? If the asking price was $130, you may have to pay $135 to get that house, right? It was a different market. It was a hot time to be, there was buyers just coming out of the woodwork, buy, and it was driving the price up. Right now, there's fewer buyers. So the suggested price on this property is $110. You might be the only buyer, okay? Keep that in mind. You might be the only person that's in line, basically standing at the door going, yes, Mr. and Mrs. Jones, I will buy this property. Now, upon purchase and rehab, essentially, basically when you sign the papers. It's really when you complete the rehab, but it sounds better. You say, how much money did I make when I signed? Well, there's an estimated equity capture in this property of $34,210. We'll call it $34. You're out of pocket with a hard money loan. Again, different show for different day, or send me an email, askmike@luinc. You're out of pocket to purchase the property is $31,000. So let me ask you the $1 million question, because it is a $1 million question. If you're coming out of pocket 31 and your equity capture is 34, what's your return essentially as soon as you complete that transaction? That's over 100% return, right? If I took 31 out of my pocket and made an immediate 34, I have a total equity in that property of $65,000 now, right? My out-of-pocket, that goes to equity. My equity capture goes to equity. So I took 31 and made 34. That is greater than 100% return. You cannot do that in the stock market, okay? So based on those numbers, it sounds like there's going to be some deep rehab. This would be a value play, about a $70,000 rehab. Again, what we teach you at Lifestyles Unlimited, you're not having to come out of pocket is not paying $70,000 rehab. And I know to many of you that have not gone through our education, you're like, Mike, wait a second. You're buying it for 31 out of your pocket and there's 70,000 in rehab. How is that? The rehab's included in the hard money loan. Hard money loans on the asset, okay? So that's a tremendous deal. What's the cash on cash return, you may ask? It's not a lot right now. We have compressed monthly cash flow. It's about a $235 per month cash flow. Doesn't sound like a lot. I'll tell you as a percentage, though. 234 times 12, what is that, about 2,500, 2,800 a year, somewhere in there? If you're making 2,800 on 31,000 out of pocket, that's about a 9% return. So, hey, as a percentage, will I take 9% tax-free all day long? Yeah, that's probably like having a 13% return. Again, go do that in the stock market. You can't, okay? You can't. So, again, that's a challenge level deal that we sent out to our members. Pretty sure one of our members scooped it up. Here's another deal. Again, this one went out last week. This one happens to be in Springfield, Missouri. It's a 2-bedroom, 1-bath, 840 square foot home built in 1948. Now, before you boo birds out there are like, I'm not going to buy a 2-1, I'm not going to buy a small house, I'm not going to buy an old house, you're immediately letting perfect be the enemy of good, and you're throwing darts at this thing saying, well, I would never do that, I would never do that. Look, our members do it all day long. Everyone needs a place to live. We fix these places up. We make them nice, okay? We make them really nice. We do new AC, new flooring. We paint everything. We repair the holes in the roof. We fix the fence. We landscape the property. So this house, the after repair price opinion on this house is $120,000. The asking price of this house is $59,900, only $60,000. So I'm just going to go out on a limb right now and say you can't build a house for $60,000. All right. I am no rocket scientist. I'm no neurosurgeon, but I know for a fact in this country, in Springfield, Missouri, you can't build a house for $60,000. But that's what they're asking. Now, suggested price, right? Let me take you back to that. We have the ability to negotiate because of this market. The suggested price is $50,000. Okay, only you're getting a house for $50,000. Estimated equity capture, let's call that $30,000. You're out of pocket. Are you ready for this? You're out of pocket. Who out there has $5,000 that they can use to buy a house? If you do a hard money loan, this is pre-worked out. $5,324 out of pocket will make you an equity capture of $30,000. My Aggie math says that's a 600% return. Listen to this bombshell. Again, we sent this out to our members. Our members have the opportunity to buy these homes, okay? This property, after repair price opinion, $115,000, okay? The seller is asking for $50,000. You can't build a property for $50,000. You can't do it. Suggested price, yes, we're able to buy at a discount, okay? We're buying at a discount. $45,000, okay? Equity capture, $31,400. I've purchased rental property in the past where just for that one property, I came out of pocket greater than $40,000. The cash flow, again, not great. It's not, it's not earth shattering, but you've got to understand the 5 ways that we make money in real estate. That's just one. That's tax free. That's what we've been talking about. That's what Dell has been talking about, Dell Walmsley, for 30 years. Now, this downturn that we're going through, this tidal wave, is what's essentially, this economic tidal wave is what's causing that. So if you even had an inkling about purchasing rental property, now, some of you are going to take that opportunity. You're going to get educated and you're going to start buying some of these properties. Let me share with you some common first-time investor mistakes, okay? The first one, crucial, understand the tax benefits. There's a lot of tax benefits. You're not buying a rental property, you're buying a business. Get with your CPA, get with somebody knowledgeable that understands this, get a good tax person on your team. But the main tax benefit is depreciation versus cash flow. Mistake number 2, thanks to this market, not negotiating the price. There's still a lot of people out there that are living in 2020, 2021, 2022 thinking, I can't negotiate the sales price. To heck you can't. Now is the time. Mistake number 3, trying to do everything yourself. Look, the only thing you're going to do is call subcontractors or GCs. Fourth mistake I see often, emotions. Too many emotions. One of the deals I shared earlier was a 2-bedroom, 1-bath built in 1948. And I can feel the emotion of people out there saying, I would never buy a house that's 70 years old. But stop the emotions. Emotions got in the way. It took me 6 months after I joined Lifestyles Unlimited to buy a dang house because of the emotions. I didn't like this because of that, or I didn't like the neighborhood, or it wasn't perfect, or it's on a busy street. I didn't like the city it was in. Didn't like the neighbors had 17 cars in the front of their house. Stop it. Okay? It's not your home. It's your investment. Get your emotions, grab your emotions by the short hairs and kick them out, okay? If the math makes sense, that is an investment. Another mistake, not rehabbing the property properly, or worst case, skimping on the rehab. Don't go into these things so thin that you don't have an extra $5,000 or $10,000 in your essentially your real estate fund, because you may need that. By the way, you're going to have to pay that first draw to those contractors. Don't go in on the skin of your teeth. If it needs to be fixed, if that air conditioner is 12 years old, don't wait until it goes out on your resident. The resident's going to be upset about it. Fix it. If it needs to be fixed, fix it, okay? If there's a hole in the roof, we're not going to go put tar paper over it and a bunch of plastic cement. We're going to get a real roofer, and we're going to fix it properly. So don't skimp on that rehab, okay? Another thing that I see on skimping is not getting your inspections, okay? This is an investment. Protect your investment with these inspections. Get the home inspected, get the plumbing inspected, get the foundation inspected. Super important. So buying time is here. Don't make those first-timer mistakes. Reach out to me for help, but always remember, it's not the money, it's the lifestyle. Make it a great day.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the host, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.